Learning Module, Market Efficiency. Topic: the concept of market efficiency. An analyst is reviewing a large cap stock that trades on a major exchange with deep analyst coverage and high liquidity. The analyst develops an independent discounted cash flow model and concludes that the stock's estimated intrinsic value is $50. The stock is currently trading at a market price of $50. Based on the principles of market efficiency, the most appropriate conclusion is that the market for the stock is A. Inefficient, as the model's estimate must be incorrect if it matches the market price. B. Efficient, as the market price appears to reflect all available information about the stock's value. C. Inefficient, as it presents no opportunity for active investment to earn an abnormal profit. An active investor's analysis concludes that the intrinsic value of a stock is $75 per share. The stock is currently trading at a market price of $68 per share. Based on these figures, the investor is most likely to classify the stock as A. Overvalued and will consider selling it short. B. Fairly valued and will avoid taking a position. C. Undervalued and will consider purchasing it. An analyst calculates the intrinsic value of a corporate bond and determines that it is $1,050. The bond is currently quoted in the market with a bid price of $1,020 and an ask price of $1,025. The market value of this bond is best described as $1,050, as it represents the bond's fundamental worth. B. The price at which it can currently be bought or sold, approximately $1,020, $1,025. C. Greater than its intrinsic value, indicating it is overvalued. A stock experiences a significant price increase immediately following the public announcement of better than expected quarterly earnings. According to the theory of efficient markets, this price movement is most likely attributable to A. A predictable continuation of the stock's upward price trend from the prior week. B. The market's rapid incorporation of the new, unexpected earnings information. C. Trading activity by corporate insiders who anticipated the positive earnings. A company announces a major technological breakthrough that is unexpected by the market. If the market for this company's stock is highly efficient, the most likely immediate effect on the stock's price is that it will A. Rise instantly to a new level that reflects the revised intrinsic value. B. Remain unchanged until analysts can fully assess the long-term impact. C. Gradually increase over several days as investors process the information. Which of the following is least consistent with the characteristics of an informationally efficient market? The market price of a stock is very close to its estimated intrinsic value most of the time. B. Significant and persistent differences regularly exist between market prices and intrinsic values. C. Active managers generally find it difficult to consistently achieve positive risk-adjusted returns after costs. A research report concludes that after accounting for management fees and transaction costs, a broad sample of actively managed equity funds in a particular country has failed to outperform a passive market index over the past 15 years. This finding most strongly suggests that the country's equity market is A. Characterized by significant arbitrage opportunities. B. Informationally efficient. C. Dominated by irrational investor behavior. A research firm tests whether a portfolio of stocks, selected based on non-public merger and acquisition talks, can yield abnormal returns. The test results show that the portfolio does generate statistically significant positive abnormal returns. However, a separate test confirms that trading strategies based on past price trends or published financial statements do not yield abnormal returns. These collective findings most strongly support which form of market efficiency? Weak form efficiency, because the test confirms that historical data cannot predict future prices. B. Semi-strong form efficiency, because the market reflects public but not private information. C. Strong form efficiency, because the market quickly reflects all new information. Market value equals intrinsic value when efficiency holds. For a large cap liquid stock with deep analyst coverage, This match signals that the market price already reflects all available information. No consistent abnormal profits are possible in such a market. The absence of profit opportunities confirms efficiency, making passive investment more appropriate. Intrinsic value, $75 is greater than market price, $68, which signals the stock is undervalued. Active investors seek these discrepancies to profit. Undervalued stocks present buy opportunities, since the expectation is that the market price will eventually converge upward toward intrinsic value. Market value is the actual trading price, represented by the bid-ask range, $1,020 to $1,025, not the intrinsic value estimate, $1,050. Intrinsic value is not equal to market value. The bond is undervalued relative to intrinsic value, so it cannot be described as overvalued. Price increase reflects the market's rapid incorporation of unexpected public information, better than expected earnings. This is exactly how efficient markets are expected to behave. Past price trends, option A, and insider trading, option C, do not explain the movement. Weak form efficiency rules out trend prediction. An insider trading would cause price changes before the public announcement, not after. In a highly efficient market, semi-strong are stronger. Prices adjust immediately to unexpected public information, such as a technological breakthrough. Waiting for analysts, option B, or gradual adjustment, option C, contradicts efficiency, since anomalies like underreaction are inconsistent with semi-strong efficiency. In an informationally efficient market, prices quickly incorporate all available information, so persistent differences between market price and intrinsic value should not exist. Prices being close to intrinsic value, option A, and difficulty for active managers to consistently earn abnormal returns, option C, are consistent with efficiency, while persistent mispricing, option B, signals inefficiency. In an informationally efficient market, active managers cannot consistently earn superior risk-adjusted returns after costs. The long-term underperformance of active funds versus a passive index is direct evidence of efficiency. Arbitrage opportunities, option A, and irrational dominance, option C, would allow active managers to profit. But the fact they fail to outperform shows mispricings are quickly eliminated and irrational behavior is not systematically exploitable. Active management cannot consistently beat passive management after costs, which is exactly what efficiency predicts. Semi-strong efficiency means prices reflect past data and all public information, but not private information. The evidence shows no abnormal returns from past trends. Weak form satisfied are public statements. Semi-strong satisfied, but abnormal returns from non-public M&A info, strong form rejected. Weak form alone is insufficient because public information is also incorporated, and strong form is rejected since private information can still generate abnormal returns. Topic: Factors affecting market efficiency, including trading costs. A government, concerned about foreign influence, passes a law that significantly limits the ability of international institutional investors to purchase domestic equities. All else equal, this regulation is most likely to A. Improve market efficiency by reducing speculative capital flows. B. Have no net effect on market efficiency, as domestic investors will fill the void. C. Reduce market efficiency by decreasing the number of active market participants. A financial regulator is concerned about market stability and proposes a temporary ban on the short selling of bank stocks during a period of economic uncertainty. According to the theory of market efficiency, this ban would most likely A. Improve the stability of bank stock prices in the short term. B. Have no significant effect on the pricing efficiency of bank stocks. C. Impede the efficiency of bank stock prices by limiting arbitrage activity. A regulator aims to increase confidence in the local stock market, where participation is low due to perceived unfairness. Which of the following policies is most likely to support market efficiency? A. Banning trades by non-resident investors to protect domestic liquidity. B. Mandating penalties for using undisclosed material information in trades. C. Adding a fee on rapid buy-sell transactions to stabilize share prices. A government is introducing new capital market rules to strengthen overall market quality. Which of the following rules would most likely impede market efficiency? A. Imposing a minimum 1-week holding period for all newly purchased equities. B. Requiring listed companies to release quarterly earnings to the public within 30 days. C. Strengthening enforcement against the use of material non-public information in trading. Following a major upgrade to its matching engine, an exchange reports that the average time from order submission to execution has fallen from 800 milliseconds to under 80 milliseconds. This improvement most likely indicates that market efficiency has A. Decreased. B. Increased. C. Remained the same. Arbitrage activity is most likely to be prevalent in a market that is characterized by a low transaction costs and minimal restrictions on trading. B. Prices that quickly and accurately reflect all public information. C. A small number of analysts and limited information flow. If the level of institutional ownership in a stock rises significantly over a short period, the market for that stock will most likely become A. Less attractive to technical traders. B. More efficient. C. More prone to persistent overvaluation. Market efficiency improves with more active participants. Restricting foreign institutional investors reduces participation and diversity, which weakens efficiency. Limiting participation does not improve efficiency, option A, and domestic investors cannot fully replace the role of foreign investors, option B, since efficiency depends on broad, diverse trading activity. Short selling is essential for efficiency because it allows arbitrageurs to act on negative information and correct overvalued prices. A ban restricts this mechanism, slowing price adjustments and creating inefficiency. Trading restrictions do not improve efficiency, option A, and removing short selling eliminates a key corrective tool, option B, so both alternatives are inconsistent with efficient markets. Penalizing insider trading promotes fairness and efficiency by reducing information asymmetry, ensuring all investors have equal access to material information, which builds confidence and participation. Restricting foreign investors, option A, reduces participants and adding transaction fees, option C, raises costs and slows price discovery, both of which impede efficiency rather than support it. A minimum holding period restricts trading activity, reducing the number of participants able to act on new information, which slows price discovery and impedes efficiency. Timely disclosure, option B, and penalizing insider trading, option C, both promote fairness and efficiency, while trading restrictions, option A, increase costs and limit participation, making them inconsistent with efficiency. Faster execution times reduce delays in incorporating new information into prices, allowing arbitrageurs to act more quickly and correct mispricings, which directly increases market efficiency. Slower execution would reduce efficiency, option A, and remaining the same, option C, is incorrect because the measurable improvement in speed clearly enhances efficiency. Low transaction costs and minimal restrictions on trading, like allowing short selling, make arbitrage profitable and widespread, since traders can exploit even small mispricings efficiently. Shy efficiency, option B, leaves little room for arbitrage because mispricings vanish instantly and limited information flow, option C, creates barriers and costs that make exploiting mispricings difficult. Few analysts and low liquidity increase costs and risks, further reducing arbitrage activity despite possible mispricings. A rise in institutional ownership increases the number of informed professional participants, which strengthens price discovery and reduces mispricings, making the market more efficient. While technical traders, option A, may find fewer exploitable patterns and persistent overvaluation, option C is inconsistent with efficiency. The primary and direct effect is greater efficiency, option B. Topic: Forms of market efficiency. If current share prices already fully reflect all publicly available information, including financial statements, analyst reports, and recent news announcements, the market is best described as a weak form efficient only, B semi-strong form efficient, C strong form efficient. Which of the following statements is most consistent with the strong form version of the efficient market hypothesis? Security prices fully reflect all publicly available information. B. No group of investors can consistently earn abnormal returns using fundamental analysis. C. Even company insiders who possess material non-public information cannot earn abnormal returns by trading on that information. A market in which no investor, including corporate insiders with access to material non-public information, can consistently achieve abnormal returns is best described as A. Semi-strong form efficient, B. Weak form efficient, C. Strong form efficient. Following the release of a company's annual financial statements, its share price drifts upward over the next month without any further public news. This observation most likely suggests that the market is A. Semi-strong form efficient, B. Experiencing delayed incorporation of the original public information, C. Fully adjusting only after private information becomes available. Following the release of an unexpectedly strong quarterly earnings report that is immediately made public, an analyst buys the stock and earns positive abnormal returns over the next 3 trading days. This trading profit most likely indicates a violation of which forms of market efficiency? A weak form only, B. Semi-strong form and strong form, C. Weak form and semi-strong form. The weak form of the efficient market hypothesis specifically asserts that security prices fully incorporate which of the following? A. All public corporate announcements, such as earnings reports. B. All information, including material non-public knowledge. C. All historical sequences of security prices and trading volume. In a market that is only weak form efficient, which of the following approaches is least likely to consistently earn abnormal risk-adjusted profits? A. Evaluating industry economic forecasts and public earnings announcements to find undervalued stocks. B. Exploiting confidential details about a government contract before they are announced to the media. C. Implementing trading rules based on historical price patterns and trading volume trends. Which of the following statements regarding the forms of market efficiency is least accurate? A. If a market is weak form efficient, technical analysis cannot produce abnormal returns. B. If a market is semi-strong form efficient, prices adjust quickly to earnings announcements. C. If a market is strong form efficient, fundamental analysis is the best approach for earning abnormal returns. In a market that is truly strong form efficient, which of the following statements is most accurate? Technical analysis can be used to identify profitable short-term trading opportunities. B. Corporate insiders can consistently profit by trading on material non-public information. C. A low-cost index fund is expected to outperform the average actively managed fund. Semi-strong efficiency means prices fully reflect all publicly available information, such as financial statements, analyst reports, news. This goes beyond weak form, which only covers past prices, but does not extend to strong form, which requires private information. Weak form, option A, is too limited since public information is also incorporated, and strong form, option C, is too broad because private information is not included. Strong form efficiency means prices reflect both public and private information. So even insiders with material non-public information cannot earn abnormal returns. This is the unique test of strong form EMH. A. Public info only, and B. Fundamental analysis using public data. Both describe semi-strong efficiency, not strong form because they exclude private information. Strong form efficiency requires prices to reflect both public and private information, meaning even insiders with material non-public information cannot consistently earn abnormal returns. Semi-strong, option A, only covers public information and weak form. Option B, only covers past price or volume data, so neither prevents insiders from profiting. The gradual upward drift after public financial statements shows delayed incorporation of public information, which contradicts semi-strong efficiency, where prices should adjust immediately. Semi-strong, option A, is ruled out because adjustment was not immediate, and strong form, option C, is irrelevant since no private information was involved. The drift is best explained by inefficiency in processing the original public data. Earning abnormal returns after public earnings release shows delayed price adjustment, which violates semi-strong efficiency. Prices should instantly reflect public info. Since strong form efficiency subsumes semi-strong, it is also violated. Weak form efficiency is irrelevant here because the profit came from new public earnings data, not historical price or volume patterns. Weak form efficiency means prices fully reflect all past market data, historical prices, and trading volume, so technical analysis cannot generate abnormal returns. Semi-strong, option A, covers public announcements and strong form. Option B, covers both public and private information. Neither matches weak form, which is strictly about past price or volume data. Weak form efficiency means all past price and volume data are already incorporated into current prices. So technical analysis based on historical patterns cannot consistently earn abnormal risk-adjusted profits. Fundamental analysis, option A, may still work because public information is not fully incorporated under weak form, and insider trading, option B, can still generate abnormal returns since private information is not reflected. Strong form efficiency means prices reflect all information, public and private. So no investor, including insiders, can earn abnormal returns. Therefore, claiming fundamental analysis is the best approach under strong form is inaccurate. A. Weak form correctly rules out technical analysis, and B. Semi-strong correctly states that prices adjust quickly to public announcements. Both are consistent, leaving C as the least accurate statement. In strong form efficiency, prices reflect all information, public and private. So no investor, including insiders or analysts, can consistently earn abnormal returns. Because active managers cannot add value beyond costs, low-cost index funds outperform on average after fees. Technical analysis, option A, is already ruled out under weak form efficiency, and insider trading, option B, is ruled out under strong form efficiency, since private information is incorporated. Reinforces that insiders cannot profit in a truly strong form efficient market, even though in reality they often do. which is why strong form efficiency is rarely observed.